everybody, this is Chris from Project Option, and in this options trading strategies video, we're going to talk about selling iron condors. So it's also referred to as a short iron condor. So a short iron condor consists of selling a call spread and a put spread on a stock that a trader believes will remain range bound over some time period in the future. So in this video, we're going to talk about the characteristics of the short iron condor strategy, and then we're going to look at 3 real trade examples to show you how the strategy performs through time in various scenarios. So let's get started. Alright, so selling iron condors is an option strategy that consists of selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. Now, the strategy is similar to a short strangle, but has limited loss potential and less profit potential. So if you really deconstruct the iron condor strategy, you have a short call and a short put, and that's going to be the short strangle part of the strategy. But then you also have the long call and the long put that define the risk of the strategy. So as opposed to just selling a naked call and a naked put, we're selling a call spread and a put spread to have less risk on the strategy. So the maximum profit potential we can gain on this strategy is the credit received times 100. So if you sell an iron condor for a $2.50 credit, the most you can make is $250 per iron condor. Now, the maximum loss potential is the width of the widest spread minus the credit received times 100. So when you construct an iron condor, you might have a call spread that's 10 points wide and a put spread that's 5 points wide. So in that case, most of the risk would be on the call spread side of the trade, and that's how you would calculate your maximum loss potential. So in regards to the break-even prices, we have 2 break-even prices. So we have an upper break-even price, which is equal to the short call strike price plus the credit received for the iron condor, and then we have the lower break-even price, which is the short put strike price minus the credit received for the iron condor. Now, the estimated probability of profit for a short iron condor is between 50 and 99% depending on the options you sell. So you might say, why wouldn't you just sell these strikes that give you a 99% probability of profit? Well, the answer is that you're not going to have much profit potential for those options because they're going to be so far out of the money and they're going to be so cheap that you're still going to have a substantial amount of risk, but very, very little reward for that high probability of profit. So it's always good to balance the probability of profit and your potential reward and risk. Now, the resulting position after expiration depends on if the full spread is in the money or if only a short option is in the money. So if either the call spread or put spread is entirely in the money, then those exercises and assignments will offset, and you will have no stock position after expiration. However, if the short call is in the money, then you will have a short stock position of 100 shares after expiration because a short call contract expires to negative 100 shares at expiration. Now, if your short put is in the money at expiration, that short put will expire to plus 100 shares of stock per put contract. So that would be a long stock position of 100 shares. So since a short iron condor position does include short options, you do have early assignment risk before expiration. So if your short call option is in the money before expiration, you have the potential to be assigned negative 100 shares per contract. Now, if your short put is in the money before expiration, you have the potential to be assigned plus 100 shares per short put. Now, early assignment is very uncommon in options trading, and the only time you really have to watch out for it is if your short option is in the money with very little extrinsic value. So that will generally happen if your short option is in the money near expiration, or if your short option is very, very deep in the money and is trading with mostly intrinsic value and has very little extrinsic value. So just because your short option is in the money, it doesn't mean you're automatically going to be assigned. You should always look at the extrinsic value of the short option to determine the likelihood of assignment. So now let's go ahead and look at a short iron condor example trade and look at the expiration risk profile graph for this position. So here we have a hypothetical option chain, and at the time of these option prices, let's say the stock price is currently trading at $500. And let's say we want to put on a market neutral trade that will profit when the stock price remains between approximately $450 and $550. So plus or minus 10% from its current price. So to do this, we're going to set up a short iron condor, and to do that, we're going to sell the 450 put and the 550 call, and then we're going to finish off the iron condor by purchasing the 400 put and the 600 call. So we're basically selling the 450 400 put spread and the 550 600 call spread. Now we're collecting a net premium of $11.38. So let's go ahead and take a look at what this expiration risk profile graph looks like for this iron condor. So the first thing to note here is that if the stock price is between our short put and short call strike price at expiration, we realize the maximum profit potential for the strategy. And that's because all of the options in the strategy will expire worthless and will keep the net premium that we collected when selling the iron condor. Now, on the other hand, if the stock price is below the long put strike or above the long call strike, we will realize the maximum loss potential for this particular strategy. So in this case, we have a put spread that's $50 wide and a call spread that's $50 wide. So our risk is equal on both sides. So it doesn't matter if the stock price increases or decreases significantly. We have the same amount of loss potential on both sides since both spreads are the same width. Now our actual maximum loss potential in this case is the $50 spread width minus the 1138 credit times 100, which comes out to $3,862. So the most we can lose in this trade is $3,862, and that'll occur if the stock price is below the long put strike of 400 or above the long call strike of 600. Now the most we can make is the 1138 credit times 100, which comes out to $1,138. And as we said before, that happens when the stock price is between the short put and short call at expiration. Now we can see that our break-even points are extended beyond the short put and short call strike, and that's because that credit we received gives us some room to move. Alright, so let's go ahead and take a look at the Greek exposures for a short iron condor when the stock price is in between the short strikes. So all of these delta values correspond to a short iron condor when the stock price is in between the short strikes. So in general, a short iron condor will begin with a delta value near zero because a lot of traders use a short iron condor as a directionally neutral trade. However, you can structure a short iron condor in a directional manner by either opening up one of your spreads on one side. So for instance, if you sell a 20-point wide call spread and a 5-point wide put spread, that's going to give you a bullish bias. Now on the other hand, you could have a short spread that's closer to the money than your other spread. So if you sell an at the money call spread and an out of the money put spread, that would give you a bearish bias. So the gamma of a short iron condor is negative, and that just means that when the stock price rises, a short iron condor's position delta will become more negative. And when the stock price falls, a short iron condor's position delta will become more positive. So in other words, if the stock price starts running up towards your short call spread, you're going to become negative delta because you actually want the stock price to come back down in between your short strikes. Now on the other hand, if the stock price falls towards your put spread, you're going to be long deltas because you actually want the stock price to rally back to the midpoint of your short strikes. So you always want the stock price to be right in between your short call spread and short put spread. Now in regards to theta, a short iron condor has positive theta, which basically means that as time passes and those options are losing their extrinsic value, you're actually going to be making money because you sold the spread for a net credit, and when you sell an option spread, you want its price to go to zero. Now as time passes and the stock price is in between a short iron condor's short strikes, all of those options will be decaying towards zero, and therefore that spread's price will be decreasing, which creates profits for an iron condor seller. So theta is positive, and that's a good thing for short iron condor traders. Now lastly, vega is negative, which means increases in implied volatility lead to losses and decreases in implied volatility lead to profits. And that's because an increase in implied volatility indicates that option prices are increasing, which is not what you want when you're short premium. Now on the other hand, a decrease in implied volatility indicates that option prices are falling, which is of course what you want as a short iron condor trader. So when you put all these Greeks together, you learn that a short iron condor is a directionally neutral strategy, and it can make money from the passage of time or a decrease in implied volatility, but it will lose money if the stock price makes a wild swing in either direction or if implied volatility increases. Alright, so let's go ahead and look at some iron condor example trades. So the first example we'll look at is where a short iron condor expires in the money. Now, the initial stock price in this case is $202.31, and what we're going to do is we're going to sell the 196 182 put spread, and we're also going to sell the 208 215 call spread. Now, both of those options expire in 72 days. Now, the net credit we're going to receive for this is $4.43, which brings our upper break even to $208 plus $4.43, which comes to $212.43, and we're going to have our lower break even at $191.57. So that's that short put strike price minus the credit received. Now, the maximum profit potential in this case is $443 because we sold the iron condor for a net credit of $4.43. Now, the max loss potential on the upside is $257, and that's because we have a $7 wide call spread minus our $4.43 credit times 100, which comes out to $257. Now, on the downside, we actually have $957 of risk. So that's because we have a $14 wide put spread minus our $4.43 credit, which gives us $9.50 per spread, which comes out to a maximum loss of $957 on the downside. So this is just an example of how you can have a iron condor that is slightly directional, because in this case, since you have almost $1,000 of risk on the downside and only $250 of risk on the upside, we would call this a slightly bullish iron condor because you'd rather have the stock price go up than down. So in this particular trade, we have a slightly bullish iron condor. Alright, so as we can see here on the top part of this graph, we're looking at the changes in the stock price relative to the short call spread and the short put spread, and also the two break-even points of the strategy. Now, on the bottom part of the graph, we're looking at the price of that iron condor. So we can see the price of the iron condor change as the stock price and time both change. So in this example, the stock price does meander between the short strikes for quite some time, and we can see that the iron condor's price does in fact decrease. However, the stock price actually does hit the upper break-even price of $212.43, in which case the iron condor's price is pretty much back to where we sold it at $4.43. Now, at expiration, the stock price settled between the short call strike price of $208 and the upper break-even price of $212.43. So even though the short call was in the money, since the stock price was below the upper break-even price, this iron condor actually still made money. So since the short 208 call is in the money at expiration, it's important to note that this position would actually expire to a short stock position of 100 shares per short call contract. So if you were trading this iron condor and you did not want a stock position after expiration, you would have to buy back that short call before it expires. Otherwise, it would automatically be assigned to you and you would take on a short stock position of 100 shares. Alright, example trade number 2, a maximum loss iron condor. So in this example, we're going to look at an example where a short iron condor expires fully in the money and realizes the maximum loss potential. So here's the setup. The initial stock price is $121.45, and what we're going to do is we're going to sell the 119 115 put spread and the 124 128 call spread. Now, both of those spreads expire in 46 days. Now, for this iron condor, we're going to collect a net credit of $1.53. And that brings our upper break-even price to $125.53 and our lower break-even price to $117.47. So our maximum profit potential in this case is the net credit of $1.53 times 100, which comes out to $153. Now in this case, we have a $4 wide put spread and a $4 wide call spread, so our maximum loss potential is the same on each side. So our maximum loss potential is the $4 wide spread minus 153 times 100, which comes out to $247. So the most we can make is $153, and the most we can lose is $247. So in the top part of this graph, we're looking at the changes in the stock price relative to our short iron condor's strike prices and break-even prices. And in the bottom part of the graph, we're looking at the price of the iron condor itself. So in this case, the stock price started at $121.45, and our short call spread was 124, 128 with a break even of 125.53. So as we can see here, unfortunately the stock price just absolutely surged from 120, 145 and went all the way up to 134 in a very short period of time. So on the bottom part of this graph, we can actually see that the iron condor's price was increasing as this move happened. So since that short call spread is $4 wide, if it's entirely in the money at expiration, it will be worth $4. Now, since we sold this entire iron condor for $1.53, we stand to lose $2.47 because if we sell something for $1.53 and its value rises to $4, then we've just lost $2.47 per spread. Now that translates to an actual dollar loss of $247. Alright, so example number 3, a max profit iron condor. So let's look at an example where a short iron condor expires fully out of the money and the trader who sells it realizes the maximum profit potential. So here's the setup. The initial stock price is $574.81 and we're going to sell the $535.505 put spread and the $615.645 call spread. So a 30-point wide spread on both sides. Now both spreads expire in 46 days and our net credit in this case is going to be $11.65. So our break-even price on the upside is going to be $626.65 and our break-even price on the downside is going to be $523.35. Now our maximum profit potential is going to be $11.65 times 100 or $1,165. Now our maximum loss potential in this case is going to be $1,835 and that's because we have 30-point wide spreads and we collected $11.65. So when you take the 30-point wide spread less the credit we received times 100, we get $1,835. So let's go ahead and take a look at what happens to this trade over time. So on the top part of the graph we can see the changes in the stock price, and in the bottom of the graph we can see the actual value of that iron condor as the stock price is changing. So right off the bat we can see that the stock price falls from $575 down to $485, which is well below our short put spread, and while that move happens we can see that the price of the iron condor increases from $11.65 all the way up to a value greater than $20. So it almost doubles in price. Fortunately, the stock price came back and settled right in between our short strikes and just coasted in through expiration. So since the stock price was between our short put and short call at expiration, all of the options in this iron condor expired worthless and the maximum profit potential is realized. So since we sold the iron condor for $11.65 and all those options expired worthless, the maximum profit potential in this case is $1,165. So this just goes to show that if you sell an iron condor and the stock price is between your short strikes at expiration, you will realize the maximum profit potential. So let's go ahead and recap the main concepts that you've learned in this video. So first of all, selling iron condors is a directionally neutral strategy that consists of selling an out-of-the-money call spread and put spread in the same expiration cycle. Now the main profit drivers for short iron condors are the passage of time because the strategy has positive theta and decreases in implied volatility because the strategy has negative vega. Now to close a short iron condor before expiration, you can simply buy back the short call spread and put spread to lock in profits or losses. Now though a short iron condor begins directionally neutral, the trade will become directional if the stock price trends in one direction. So when you put on a short iron condor, you do not want the stock price to trend in one direction. And if you believe it will, then the short iron condor may not be the best strategy. Now in general, a short iron condor will have more loss potential than profit potential, resulting in a higher than 50% probability of profit. Now in some cases, depending on how you structure it, the profit potential might be greater than the loss potential, in which case the probability of profit is less than 50% in theory. Thank you for watching, everybody. If you enjoyed this video, please go ahead and subscribe to our YouTube channel so that you can receive updates on all of our new videos as we come out with them.